So the way I see this is in equities, I think that for a young person, equities should be the largest allocation because it is the most balanced asset class in terms of the aspiration of a youngsters for making return while also not giving you extreme high level of risk. Investing in US securities directly when you invest in direct stocks. There you are actually playing like you are on a Formula One circuit when you have just learned driving. We have always been made to influenced in a school of thought, and we seek community belief. Haha, this is the right thing to do. So that same thing plays out in every cycle, and that is what we are seeing right now.
Please note, this is not financial advice. Do consult a qualified financial advisor and use your discretion. Namaste and welcome to the Bharatvaarta podcast. I'm Roshan Karyappa. On this episode, we have Abhishek Murarka, who heads community and growth at Multipie, which is a social network built exclusively for investors. He's a chartered accountant and MBA from IIM Lucknow and has a decade's experience across equity research and investment banking. Today, we're going to talk about personal finance, investing, the markets, the economy, and how new investors can grow their wealth meaningfully. We have a lot to cover, so without further ado, welcome Abhishek. Thank you for being on Bharatvaarta.
Hey, hi Roshan. My pleasure to be on the show. I want to compliment you for building a fabulous, I would say, podcast series. And it's my privilege to be here. I've seen the kind of guest you have had on the show.
Thank you so much. Thank you for the kind words. People have been entirely kind with us. Yeah, I mean, and I've followed you on Twitter for a while, and I must say that, ounce for ounce, you post the most useful content on all of these topics that, mentioned earlier. So, very glad to be able to speak with you today. But it's also a subject which is kind of complex and complicated, right? For most people, personal finance and investing is very intimidating. We know that financial literacy in India is so low, right? About 5% of Indians, or perhaps less than that, invest in the markets, although that percentage is steadily growing. But let's begin there. Why do you think that is the case? Why do you think that we don't have a better introduction to finance or economics and stuff like that?
That's a very good question at the start right away. My view is I completely agree that there is a long journey we have on financial literacy. I don't know if the number is say 5%, but yeah, from my experience, I can say the bigger question is what exactly is financial literacy? I have seen like people who are MBAs from the best colleges, they make the most common mistakes. They have revolving credit, they pay the minimum balance. There's a very thin line on what is literacy and what is financial literacy. So that
Hmm.
person is at the epitome of, I would say, literacy or MBA from a peak institute. But if they are making basic money mistakes, then it's there. And now let me think from that lens. Why is that person so educated? Even we, like many of us do these mistakes. I think it's something to do with two things. One is for long money has you learn things either in school or at home in your foundational years. And let's look at both lens. In school, money is not a topic that we discuss about, and even at home, I think as a society, money has long been a taboo for discussion at home. Even if a family has a certain stance on money or has a situation as kids, or leave apart kids, even when we are like say mature or in our growing years, we are not aware of how our parents are dealing with money. So I think it's a
Hmm.
amalgamation of both things, and they have to change. You look at I think one good aspect I think is in the western societies on money. I think young kids tend to start making pocket money on their own. I've seen in movies kids walking on cycles and throwing newspaper. So that realization of
Yeah.
earning your money and those things, those are some small bits as parents also, like it can be incorporated. But the other part I told you is we our first experience with money happens when we start working, and then we are clueless. And then when you're clueless, then you
Yeah.
kind of behave with money in two ways. One is your immediate peer circle, or you are influenced by your, I would say, the way the industry works. So yeah, those are some thoughts I have on this.
No, I couldn't agree more. I think money management is about habits and principles, right? More than, let's say, certain knowledge or whatever, right? I mean, it takes a while for this to sort of mature, and for you to imbibe these things, and for this to translate into wisdom, right? And so I think a lot of us just lose out on the many years that we could actually have trained ourselves in these principles. As someone who's sort of mature on the subject, what are some three or four principles that you have realized over your experience that have held you in good stead and that you would recommend to others as well?
There's a saying that investing is simple but not easy.
Hmm.
Now, what that line means is the core tenets of what one should do are basic and easy to understand, But the part that is not easy is controlling your behavior, because your mind will gravitate towards things that would deviate from the basic principles, which is a cycle of greed and fear. So few things I would say that one needs to do. One is, it takes a lot of time for one to control their behavior with money. So what one can do, what has worked for me, is don't control what I call your monkey brain. Let your monkey brain remain, but cut down on the magnitude of mistakes that monkey mean brain can make in terms of investing. Say for example, what I mean is, if you know, like I've seen often people, it's not that they don't know they are taking undue risk, but at that point the element of greed is stronger for them. And what one can do in this is, like, make at least make a demarcation. It's the parallel is, if you say, if you are on a diet or if you want to lose weight, if you are somebody, you know, you just have a very strong craving for a dessert, you still will have a cheat day. So have a cheat allocation, the way I put it. If you want to still, if you are attracted to crypto or anything that you feel you don't understand but that looks like easy or quick money, you put a portion size to it. That is one thing that one can do. Second thing that a person should do is understand, know yourself. I think this is the most difficult part. Make your own mistakes, but understand yourself. And how one can do it is, say for example, if you're investing, think of, first you need to understand your own risk appetite. It's the most boring part, and the most difficult part is because people are chasing returns, and returns can be measured, but what amount of risk you are taking to make that returns, that cannot be measured. You can still say, okay, this is high risk, but how much high risk? Can you lose your capital? So those are the aspects people don't understand. So what you can do is, till you don't understand, first you can always start with a allocation to an expert. That if you are investing, if you're looking at asset classes, let's start with say three. Let's start with equities, let's start with fixed income, and maybe let's start, a young person may not have enough ticket size for real estate, but you can still have something like gold. So the way I see this is, in equities, I think that for a young person, equities should be the largest allocation, because it is the most balanced asset class in terms of the aspiration of a youngsters for making return, while also not giving you extreme high level of risk. So you, in equities, you can have a same balance split, do a disciplined investment in a mutual fund or an index fund, wherein the ownership and responsibilities with an expert. Your task is to do it in a disciplined way. Now, people have, like, one reason people invest also is, you get a kick, you get a thrill out of investing. So I will not use the word thrill or kick as a main driver. I think investing in itself, it's a brilliant exploration of yourself and exploration of journey of learning. Somebody who starts loving investing starts loving learning, because to invest, you have to understand something, and then when you do it, you become better decision maker in all aspects. So I am a very strong proponent of doing a balanced way of investing in, for a youngster to start doing in a mutual fund or an index fund, and start investing on your own. Make your mistakes, make your mistake at a young age, make your mistakes on a lesser capital base. Because when I say capital base, let me bring one element that I very strongly believe. In this compound interest formula, the formula is amount equal to principal into 1 plus rate of return to the power of time. So the entire industry is chasing that R, which is rate of return. But the most important element, I would say equally or more important element, the most important is time. The compounding works backward. Like, to give you the most general example, 95% of Warren Buffett's wealth has come in the last 8 years, and he has been investing for 8 years. So what I mean to say here is, we have to give it time, but at the same time, the other two elements, which is P, which is principle, I keep on, and I run a community like you mentioned. I have seen one thing that has happened in the last couple of years is, the element of greed became so strong that people just know that, let's look at example. There was the kind of things you heard, like rock pictures were being sold for millions of dollars. And the most extreme I heard was, I think it was a French artist who sold an invisible statue for some $1 million. He says it's there. You have to see it. So he sold an invisible thing as a state of art. So you can imagine where the cycle of greed was.
Yeah, products for the bull market, right? Basically.
Absolutely, and I think what happened, like this keeps on happening. And when you say sort of bull cycle, there's a like I was telling you, there's a quote at the start that in science, knowledge is cumulative, and in investing or in finance, it is cyclical. People have learned the mistake, and then they gravitate towards the right things. A new cycle starts. a new generation comes in, and along with that, it sets of perverse incentives, all the mistakes they keep on repeating. That is why I'm saying, even if I tell you the best three things, you will still make your mistakes, but try to make it on a lesser capital base. Try to not blow out, because when people blow out, they tend to leave the markets altogether. I'm a very big proponent of investing for the long run, and I think on Bharatvaarta you have a lot of good guests on policy making, on changes structurally, and we cannot agree more that we are in brilliant times. As a youngster, you won't have a better time to start investing, because I am a firm believer this next 10, 20 years are golden years for the country. And so why should you not look at that and invest, like, in a way, for the long run, and ignore the noise? Another fad that I've seen developing is, hey, let's invest in the US market. So I'm not saying don't do it, but there are few aspects of the market in equities. I would say one is futures and options. Second is investing in US securities directly. When you invest in direct stocks, there you are actually playing like you are on a Formula One circuit when you have just learned driving. So the way to think of it is, your driving skills have to match the kind of traffic you're going to face. So when you're an expert in all kind of traffic condition, then you should venture into playing the expert game of Formula One. Like in future and option, I've seen people lose their capital belly up and they leave the market. And then they move into real estate and equities. And that is one reason, if you see the kind of equity saving allocation we have in the country is very low. It's hardly 4 or 5%. China is 13%, US would be around 50%. What has happened is, one, if you see that those are older population base, so it's not that as a country we are doing something stupid. We have started our I would say interaction with money is also young, is new. The rich, 80% of the money in US is with people who are 60 years of age, and we are a country wherein the average age is less than 30 years, 20 years, 25 years. And I think it's all that is happening. Nothing is an anomaly. It is all like falling in place. It is moving in the right direction. If you see in terms of, say, number of demat accounts, the number of demat accounts that have been added in the last 1.5 years is more than the cumulative number of demat equity accounts opened in the previous 15 years. Again, it has started dipping. So this thing is cyclical, but I don't think it is completely cyclical. It is cyclical with an element of structural trend. And currently, since we are a young country, I would say the structural undercurrents are so strong that I am the biggest proponent of learn investing, and that is what we do actually at Multipie. We are building, like, we feel there is a need for this. We are building a verticalized community of investors wherein people have all the right tools to do own analysis, plus they can overlay their thesis and discuss their thesis, or just hear the views of the community of investors. You can figure out the right person to talk for anything. So I think that helps, and that also shows in the kind of decisions that people have made. Like, there's a saying that when you should be buying, you are running away from the market, and when you should be thinking of actually not being too aggressive, you're all out in the market
Yeah.
doing all the kind of mistakes. So yeah, so I think I've seen, like, it early signs are there that on average the community makes less mistake, and this is true if you think of it this way. Like I was telling at the start, our interaction with money happens very late. And when how do you invest? You, even in the offline world, you have a close circle of friends. So that is social. But that is very fragmented. And we think the entire, like, if you even if something registers in your mind, the entire process is broken from there to making that decision of allocation. By that time, actually what happens, how do people make decision? People don't make decision rationally. So you make decision on the most recent thought which made an impact on your mind, and you make big money decisions on that. So yeah, so those are some thoughts I have on this.
Right. Since you brought up equity and markets, right, and let's talk about that now. For someone who is a complete noob, what is the best way to get started on the equity market, right? And you mentioned investing in mutual funds, or working with fund managers and so on, but also maybe allocating a small, maybe like a very small portion directly in equities as well, because then you get a taste of it, right? I mean, then you can probably do some research on the business, on the market, on the economy, understand a little more, figure out how things work, how numbers move, perhaps, right, when you should be buying, when you should be selling, and all of those various attributes. So for someone who takes this advice and starts to directly invest in equities, what is the basic knowledge and research that the person should do and should have?
Absolutely. I think the most basic thing one can do is, like, if someone is working in a company, get curious about your company and the industry. It will help the person in their career also, but it will also get you started in investing. There are people who have generated market beating returns just by investing in one or two industries, which technically we call circle of competence. So start with your circle of competence, your industry that you understand better than some other industry. Say for example, if I am working in a consumer company, or if I'm working I'm an engineer working with a manufacturing or an engineering company, I can understand trends in that industry better. So you need to focus. The entire space is big. Like you are saying, it's complicated. I still believe it's a very beautiful process of making it decomplicated. You start with your industry and start with your company in the first place. Read the annual report of your company. And by the way, if you read the annual report of your company, it will start showing you the annual report of the company has sections. Like even the annual report can look daunting. It is 200 pages, but for somebody new, even if you make time to read those 15 pages out of those 200, you will have an edge over your peers. And those can be as simple as in every annual report, there is a management discussion and analysis section, which is hardly 3 4 pages. There's a letter from your chairman of your company. It will help you align directly with your CEO or your chairman of your company. And in any organization, the thought process flows linearly. If you automatically align with, if you understand what your CEO is thinking, you will do your work better because you will know what your manager wants. Because what the manager wants is what is coming from the CEO minus one. So that flows. So that helps both in career and in investing. When you're doing it, I have few. First, let me tell you, we are in, I would say, brilliant times. The amount of easy information access we have right now, nothing of it was available 10 years back. And if you go back 20 years, people could make money just by being in a particular city, being closer to the exchange. If it is in India, if it is Dalal Street or it is the NSE, you can make more money just by having access. Now that edge is gone. And trust me, a lot many people made money that way. You would have seen the series Scam 92. They showed the shop floor in the early days.
Yeah.
These people have information asymmetry. Abhi, all that is gone. The most, I would say, astute fund manager has the same access to information that you can have. And you don't need too many things. The idea of investing is not to get yourself confused. Anyone who invest, you need to know that, अच्छा, ये चार चीजें करनी है मुझे. So now what are the four things you have to do if you're looking at any company? First thing is, you don't make a buy or sell decision till the point you can go and explain your mummy कि what does that company do. जब तक you practice it. If you can't do it, then don't invest directly and you'll love it. Say how you do it is, go to the website and just see their products or services what they offer. Go to YouTube. In current times, I would say most companies put out a corporate video, explainer video 10 minutes. Understand it because we are visual beings. So do that. This is what I do. It gives me a visual flavor of that company. Third thing I would do is, there are two documents in every company's website which is listed. There is an investor section. Open two documents. Open the annual report and open the investor presentation if there is one. Investor presentation is more easy to digest because it is more visual. Again, it's a presentation. We are used to seeing presentation and digesting. So, and you in annual report, I have told you what you can do. So, all of this will maybe take you more time in the early days, but gradually you will realize this process becomes very quick and faster for you. And more you do, you also start realizing that the good old Pareto rule applies even more in investing. You know that the 20% of things you read are the 80% of things you need to know to make a decision. So that you every person figures out for themselves. And by the way, let me tell you this. Roshan mentioned I write on Twitter. I'm a big proponent on using social media the right way. If you can use social media the right way, it is more powerful than any other tool for your learning. It is more powerful than Google also, because if you think of it, Google also, the results when you Google, they are SEO enhanced. I'm not saying those are bad results, but they are not the most real information you need. They are the most right or the most searched information. So on social media, I think just follow the right people. Trust me, follow the right people, and it will automatically start shaping your views the right way. And as important as following the right people, you also have to understand what not to follow. If you are seeing something and if you feel that the emotion, say if you're seeing a video, and if you feel the emotion you are being sold on that video is something of greed or something like a get rich quick kind of a scheme, you have to question that, are you making a rational decision? Because cycle after cycle, time after time, only one thing is proven, that both greed and fear normalize. I can put it this way, that what you should do is take, if you're really passionate, spend maybe 30 minutes to 1 hour every day learning. And yeah, that is the approach I would suggest.
So let's talk about investing versus trading, because I think most people kind of confuse one with the other, right? What are some fundamental differences, and what would you recommend in terms of who would be right for one versus the other? When is it more suitable to invest versus trade? Yeah, and if you could just lay out some few principles on that as well.
The Before we draw out any principle, we should understand the reality. The reality is the exchange turnover in the last 1 2 years. 95% has been driven by trading and in FNO. So you can imagine that for every 1 rupee which is invested in equities in cash market, 25 to 30 rupees goes into FNO. And like I was telling at the earlier part, it's you are playing, you are on a formula circuit if you're doing FNO or in early days when you have just learned driving. And people don't talk this enough because this it's a taboo to say, hey, I lost a lot of money. But the way I see it is, trading should come, I would say, gradually. What happens is, I'm seeing that more and more youngsters are taking to trading than investing, and we need to understand why. The reason why is, you have to have the right expectation from equities as an asset class. It is not a get rich quick scheme. Think of it this way: when if you invest in FD, you think of 4% and you are okay with it. And when you come to equity, you just want it to be 100% in 1 year. It can't happen. And the moment you chase anything subnormal, you're also taking subnormal risk. Like I told you, you can't measure risk. You don't even realize what you are doing.
Yeah.
So my view is, and I just keep on telling this, Roshan, I have seen this. I'm a CA by background. I have seen so many CAs on my timeline who follow me, or I have seen 80% of the things they tweet out are charts, trading charts. Now, if everyone is doing chart, what is your edge over someone who has been doing it for 20 years, 30 years? By the way, take for example the brokers, the most prominent, I would say, owners of broking houses. Even they have been coming on record and telling that they have the real data. Only 1 to 3% of people make money, which means 97% of people lose their capital. And it varies. Somebody can lose 20%, somebody can go belly up. And if you go belly up, then you lose on the T element, which I was telling in the compounding formula. If you're a young person,
Yeah.
the biggest advantage you have is time, because like you can Google it, you can search for it. If you are not making stupid mistakes between 20 and 30 or 20 and 35, by 35 you will be better off than 99% of your peers. The rule is, don't make stupid mistakes. You are better than most. There's a quote by Charlie Munger, that all I want to know is where I will die so that I don't go there. So I'm not saying that trading is a complete no-no and you will die there, but I have seen people die, in the sense lose their capital. Let me make an honest confession. I have lost, in one phase, a decent chunk of my capital trading, because there's something called beginner's luck. I don't know how this market works, but it'll always make you win in your first few trades, and it'll suck you in. And then there are the few things. You lose money and then suddenly you're shocked. Oh, I lost money, and then you throw more good money. After that bad money, trying to recover it. I think one psychology that people have to, behavioral bias people have to accept in trading, is sunk cost. If you are trading and you like it, enjoy it, great, but also learn that what is sunk cost. If you have made a mistake, ensure why you are making the next few trades is not to recover that money, but again assuming it never happened. If you're able to make peace with that reality, then you can trade. If you can't, then you should not trade. So you will have to learn, is your behavior designed to be a trader or not? People can make money in trading, but your psychology and your behavior, your the way you how you react to situations, is how you become a good trader. So I think trading is not for everyone. Even I would say direct investing is not for everyone. Being the right way to invest takes both time and effort, and at times people may not have that kind of luxury of time and effort, or just might not have that kind of interest. So for that segment, I would say mutual funds and index fund is the right approach. Somebody who has that passion and drive, they should invest the way I said. Learn your industry, your company, and go and keep expanding in adjacents, then read the next computer company. Then you go and figure out. I can tell you, we have, for every bad apple in the ecosystem, there are many good educators, teachers who have come up in the last few years. They're putting out their best of content for free. If you follow the right people, you have an edge. Then say anybody who took 10 years to learn that, you can learn that in 2 years. But you have to figure out to follow the right people. At the same time, also figure out who you are as an investor or a trader.
Right. I think, since psychology has come up multiple times, one book I would definitely recommend is The Psychology of Money by Morgan Housel. Right. One of those fantastic books on personal finance and investing and so on. Definitely check it out. Abhishek, a lot has changed specifically since the pandemic, right? We've seen record number of investors come into the market, and these can be attributed to the newer fintechs that have made it very easy to invest and trade and so on. We've also seen the rise of these finfluencers, right? People who make content on YouTube, on social media, etc. While I think that a lot of the content is, good and insightful, but also there is a flip side to that, right? I mean, there are people who are gullible and who kind of fall for these get rich quick schemes that you mentioned. So what is your take on this newer ecosystem that is kind of emerging?
I think this happens in every cycle. But currently, whatever we have seen in the last, since if you're talking of, say, finance influencers, which is finfluencers, I think it's an amalgamation of few things. One is people have access to a trading device at the blip of a moment. Like people are trading on their phones all the time. This was not there in the previous bull cycle. Plus, that things, the entire feeling of, I would say, FOMO, which is greed, that gets exaggerated very quickly through all the social channels. But before we talk of this, Roshan, understand that as people, we are not really rational beings. Plus, we are always getting influenced in all domains of our life. It is just that the, I would say, outcomes of, I would say, getting influenced in the financial category can be like real money loss in hindsight. So people, this becomes such a big topic of debate. But if you think, we have had motivational speakers, I have few contentious views. If I'm not sure if I should bring it on the show, but think as a country, say if we talk of Babas, Swamis, or if we talk of even religion, we have always been made to influenced in a school of thought, and we seek community belief. Haha, this is the right thing to do. So that same thing plays out in every cycle, and that is what we are seeing right now. Now, to your question on many new fintechs, apps, so in terms of money, I see this as stages of access. Till 10 years back, the, I would say, the barrier was actually just the cost of making an investment. It was so high that many people wouldn't do it because the expense was very high. Now with all the discount broking, everything, that barrier is gone. The access of, I would say, cost is very low. It's not there. Then the next thing that you need is basic education. And I would say, you mentioned the start, financial literacy is just 5%. It comes here is there is good and there is bad aspect to the finance influencing thing. And like in any cycle, it started, I would say, on the note of education. So some of the most prominent creators, educators, influencers, their content also has changed a lot. You can just Google your favorite or go to YouTube on your favorite YouTuber's channel, see the content they had 2 years back and see the videos they have had last 1 year. You yourself will see a difference and understand what has happened is these influencers, I would say, what has come in picture is human psychology of greed and fear. So what has happened is, say, perverse incentives have been at play. So we can talk of this. Understand how it happens is, how does influencer make money? A person who reaches that peak of being a good content creator is putting his heart and soul into it. I also don't undermine that. So that person is putting a lot of hard effort into becoming a person of influence. Now, how does he make money from it? The three means, can he make money by making his video paid? No. As a country, we don't pay for content in any form. And this like started like in even now we don't pay for the best of content when it can cost us 200 rupees. So they make money from advertisement, they make money from number of views they make on their videos. And the third and most prominent thing that came in the last couple of years is making money from sponsorship and endorsement from some of these brands. Now, for these brands, they also realize that as a country, the population is spending most of the time on video format, which is like easy to consume and quick to consume. People, if you just move in a Mumbai metro a Mumbai local train, you will see people are on their phone consuming all form of content. So what has happened is the weightage of people who are consuming content is disproportionately high on these platforms. And these influencers who gained might, they also realize the kind of influence they have is dominant. And brands are very smart. So I think of it as this way, that even brands are aware that some of the things may not be the best thing, but they are ready to take the red pill because it will give them a quicker access to the user base. You understand the entire ecosystem, how it works. The way ecosystem works is the entire startup ecosystem needs venture money, and venture money also knows that the risk taking on venture money is extremely high. So they have to grow, like the one that succeed has to grow extremely fast. To grow extremely fast, the easiest channel is influencers who will be endorsing these products. So I personally don't think it is a negative or a bad thing for an influencer to be making money via sponsorship. I think it is a completely right and justified way. But what has happened is, like, there is also needs to be an element of education even in the product, and that is a moral responsibility of the influencer, that the influencer points out two things. One, that clearly it is a paid collaboration, because when you say that, then it is up to the common sense of the person listening to it. Second is, I really think they should pronounce the risk to an extent. They won't, like, I know they will not be doing it as prudently as a financial advisor, but they should still pronounce some risk. Let's say, for example, a recent case of a crypto platform that went belly up. Now in this case, the influencers who promoted it, they used the words like, this is risk free, this is guaranteed returns. They even went on to call it fixed income and fixed deposits. And it's not fixed. People lost their capital. So I think those are a few things that need to come in mind. Now this is for the influencer, but even as somebody listening to it, you also have to behave more rationally and always remember that investing is not a get rich quick scheme. It is a companion for life. It is a life skill which will give you benefits over 10 years, but don't look for any visible difference over the next 12 months. So yeah, Roshan. So Roshan, first thing we need to understand, we need to look at the bigger picture of the country, like understand the diaspora of the country. One thing is, in the last 2 years, the markets have done very well, and we all understand that happened through not through measures of the central banks, meaning the US Fed, easy money, money printing. And what has happened is, in the last 2 years, the larger chunk, the population who has come there have two nature, two common features. One is 80% plus, or maybe 88. These some data is there in the broker presentations. 85 to 90% of the people who have come in, they have come in from the hinterlands. They have come in from tier 3 and tier 4 cities. And also you can say that 80% of the people who have come in, they are 20-year-olds coming in for the first time, or a smaller segment is also older generation giving into FOMO and coming in very late in the cycle. What has happened is, when this population comes in, they have to have a right way to consume, like learn. I cannot iterate it enough that you should not seek thrill in investing. Some very wise people have told us time and time again that investing is not a place to seek thrill. If you really want to seek thrill, like take a flight to Goa, go to Delton, and you can have your thrill. It's legal there. But don't seek thrill in the capital markets, because it will push you back by many years, like few years, and mentally it will push you back many years on equity. So don't do that.
Right. No, I agree with you 100%. I think, in the world of excesses that we're living in, it calls for greater moral character on all of us, right? Whether it's influencers, or whether it's investors, or whether it's even some of these platforms and startups, for sure, right? Yeah. So another thing is that we're often told that institutional investors, whether it's domestic or foreign institutional investors, they sway the markets, and the retail investors get the rough end of the larger machinations of these folks, right? To what extent do you think that is true?
There is some truth to it, definitely, but I think even this has been exaggerated in the last 2 years of the bull cycle. I don't think in the previous bull cycles we would even track how much our FI is buying and selling. So trust me, no one even bothered. And I can go on to say that even if somebody doesn't even look at that data, they are better off. If somebody is trading, then yes, it helps. If you want, I can share a link with you. I had done an analysis of the flows in the country on like the entire market, how much money comes in from FIIs, foreign investors, investors and domestic ones. So since you're asking, let me just give one picture of it. Institution, the foreign money will move much faster in both direction than domestic money, because the FIIs, the foreign institutional investors, they have a long and a short mandate both. Whereas the Indian mutual funds, which, and by the way, I don't know if people know, the largest institutional domestic money is LIC,
Yeah.
and then the entire mutual fund industry. So these are long only funds. They are not a hedge fund doing long and short. Invariably, like FIs are selling, it doesn't mean that the country economics of the country will go down. It is a nature of it. And by the way, also understand that even in the entire noise of FIs have been selling, FI has been exiting from Indian markets, the combined selling of FIs, while it is highest ever, the other side of the mirror is even the buying by the domestic institutions is the highest ever by a mile. And that is because as retail investors, the SIP money is coming in bigger than it. So like more than 1 lakh of SIP money comes in every 12 months, which never happened in the past. The way I see it is, don't pay too much of heed to FI buying and selling. One advantage as a retail individual investor you have is you are not accountable to anyone. The moment you realize that you're not accountable to anyone, you don't have to disclose your NAV. Like a mutual fund has to disclose their NAV on a quarterly or whatever basis. As an individual, you don't have. If you ignore all this and just focus on this, okay, the only thing you need to know as an investor is this a company that I understood? Is this a space where I formed a view? It has a good runway. Can this company grow well in this runway in a profitable way? Is the management someone whom I like, I can trust? And the last thing and most important thing is, I will not overpay. Like, I'll just get some sense of the valuation that the company is at. There are very many tools, but if I can tell you one, there's a tool called Screener. Just go to that company's page on Screener, and on Screener you will see the price chart. Near the price chart at top left, it shows you the valuation metrics, price to earning, EV beta, and all that is for free. It also shows you over a period of time. If you see the price to earning, which is a valuation, like technically we measure it in standard deviation. Again, I iterate, you don't need to complicate, you don't need to know if it is two standard deviation over or not. If it is a significant valuation deviation from its historical valuation range, you know that you are taking some risk on the valuation, and you better know why you are paying it. These things, you don't overpay when you make your entry investments. Invest in a company which you like, industry that you feel has growth, and industry that you feel has growth, you'll keep on getting this. You can connect the dot better as and when you invest. By the way, let me tell you, Multipie as a community can also help in this, since we ensure the kind of content goes into more feed. It's algo driven. Are the content which like has a lot of coming from experts and validation. So you might start learning how the experts are thinking and learning. So that might also help you look in the right direction. So Roshan, long thing short is this domestic money, institutional money. You will do fine as an investor even if you don't know any of this. Investing is the most in right when it is like business like. Over time, if you can start thinking like a businessman, think, will I be okay running this business? Only then I'll invest in it. If you have that, then you can do that in your investment portfolio. Let me give you one more thing that I do, and this came over time. If you really want to, if you think you want to try multiple things, have allocation to your mental strategies. Have a core portfolio which will be built thinking 10 years and not the next year. Ask yourself, will this company survive for 10 years? Second thing you can have, you can have a trading portfolio. Keep a trading portfolio and you decide what is the capital you want to put in it. Always remember, if that allocation say that you're okay to lose that money. In trading, it can go to zero. In investing, it doesn't go to zero unless you just invest in all duds. And the third thing you can do is, like I was telling you, leave it to the experts. Give it to mutual fund managers, give it to index fund, or maybe now there are many good alternate schemes. There is a small case strategy. I manage a small case. If you want, we can talk of it later, but be aware of what are all the tools. Let me also put it this way, that fintech innovation is not a bad thing. Innovation always brings progress. Both the innovation is not bad, fintech is not bad, both the influencers are not bad. You'll have to understand that with every one good apple, you'll get 9 bad apples. So understand, are you eating the good apple or the bad apple? So that is the way I would put it.
Yeah, I guess have greater discretion in terms of what you consume and what you invest in. Obviously, I mean, there's a lot of optimism for India, right, in this conversation as well. When we zoom out and look at the big picture, what are some unique attributes of the Indian economy that makes you really optimistic as a retail investor?
I think there are many things. I can say one thing I see is industry and policy making is thinking in the same direction. Policy making, the kind of policy measures you can think of, say, production linked incentives that have been announced, or if you look at, say, just our digital infrastructure that we have been able to create in the last 7-8 years, and if you combine that with the nature that we are the youngest country. If you map our age pyramid with China or US or any other country in Europe, you'll just see that we are in the sweetest spot as a country in terms of young population. Now that is both a responsibility and a risk. I also tend to get like thinking that is this really a demographic dividend when everyone is spending all the time on some random YouTube videos? They're like things which add nothing to your life, things which are dumb, they get millions of views. And let me put it this way, Roshan, I can say that your podcast, in my mind, is among the top percentiles. It's among the best.
Thank you so much.
Even the people who are listening to this is not the mass. The larger chunk, it will be over time. I think as a country, I think when that has come in measures, you think of it, some regulations have been coming in, what kind of data and what kind of apps you are using. If you ask me the right direction, like policy measures, the PLI schemes will have a huge GDP multiplier. We are in a great inflection point as an economy. I don't know if our journey will be the same as China or US. No one knows. We never had a manufacturing revolution. We had a very strong agrarian economy and a decently growing service economy. We were never the main manufacturing economy, but we have all the right ingredients to become a powerful manufacturing economy. We have the talent, we have the purchasing power parity such that you have the right talent at the right cost, which can give you an arbitrage of selling it to the world the way China sold it. So I think those things make me very optimistic. I would say the biggest optimism is all these things coming together at the same time. If they were happening disparately, like say for example, if I had a young population, but if I didn't have the digital infra, or if I had the digital infra and young population, but policy measures not being progressive, I would not have been so optimistic. But when I see all of this happening together, I can say that if you just to put your money in the index, your money will do better than any other asset class, and I can say will do better than even crypto if you give it 10 years.
So let's thread that a little bit, right? I mean, so what are some of the sectors that you see as big growers over the next few years? What are some of the individual sectors that you're or industries that you're really excited by?
I think the most obvious one is banking and lending.
Yeah.
And when I say banking and lending, lending is the non-banking part, which is NBFC. For the entire, if you see the entire economy, the various sectors that make the economy, but banking or credit is the heart. If that heart doesn't pump in money to all the segments of the economy, nothing works. And we as a country are just starting on the credit penetration. We're severely under penetrated in terms of credit, and the combination of you, if you see that way, we are already very, I would say, consolidated in terms of the leaders in every industry. So the way I see it is, some of the names might look, अरे people think अरे ये तो इतनी बड़ी company हो गई है, इसमें how will I make money putting in that money? That's a wrong approach. The way to think of it is it big enough in the scale of the global pie? No, we don't. Our largest bank doesn't feature in the top 10 banks of the world. If I expand and say top 50 banks, maybe one or two banks will make it. But in terms of consumption of credit, we'll have a huge runway. So very bullish on the banks, and I cannot iterate it enough. Don't be very adventurous when investing in financials. Even if you want to be adventurous in looking for the next multi-bagger, which is a small company in a non-banking space. But in banking, what happens is it's a natural selection. The model works in a way that a bank which has the lowest cost of capital has the luxury of making low risk lending, and banking work on very high leverage between 6 to 10 times. If things go wrong, banks can go belly up. We saw what happened with Yes Bank. It was a star bank, but you as an outsider cannot even figure out what is the kind of risk that bank is taking. It's my favorite industry to discuss. So Roshan, if tomorrow you want to discuss banking, I can do a 1 hour video on banking, but to make it short, don't be adventurous in banking. If you just be with the best banks, I'm very bullish. I'm extremely bullish on the non-banking part of it. Take the entire MSME as a segment, micro and small enterprise, and understand who is creating value in that. Value is created on the credit side, on the manufacturing side both, and the service side. So understand who will make money. So in NBFC, again, banking is very consolidated, but NBFC space will see consolidation. So if you just stick with the best companies, the leaders in the NBFCs, they'll do well over the next 5 to 10 years. The other sector that I'm very bullish on is the entire manufacturing space. Like we were saying on the PLI scheme, this has never happened in the country, and the kind of, I would say, multiplier effect this will bring will be brilliant. And I would say this one theme that I'm very bullish on is the export theme. Any company which is able to gain in the revenue mix, if you see the mix of exports increasing, it means their margins would invariably increase because companies tend to make better margins on the exports. And if they're able to export, it means they are also meeting a lot of quality checks, because not every company can export to the countries. So very bullish on the manufacturing and industrial space. The third space I would say I'm pretty bullish on is the entire, I would say, hospitality space. The hospitality space, my view is not like a 10-year view, but maybe a 3-year view. The kind of pent-up demand we have had in the post COVID. And the numbers we are seeing, like every hotel is fully booked out. If somebody is applying for a visa in US, but the dates they are getting is next year, mid of next year, 1 year down the line. That shows there's a lot of pent up demand of discretionary consumption. I am bullish on all forms of discretionary consumption because if you think the recovery has actually been K-shaped post COVID, now I'm thinking as an investor, you have to also think like a capitalist. So the K segment का जो ऊपर वाला portion है, that portion has a lot more savings than pre-COVID. So don't worry about inflation and all that thing. That segment will consume very aggressively over the next 3 4 years. Anything discretionary is travel. Anything discretionary is automobiles. So I'm bullish on say even travel, auto. Now in auto, you'll have to choose the right player. I'm bullish more on auto ancillaries. Same way I'm bullish on telecom and telecom ancillaries. Say even in telecom, we are seeing a 5G revolution will play out. The beauty of the country is that take any industry, Roshan, and we are at a very interesting juncture in that industry.
Please note, this is not financial advice. Do consult a qualified financial advisor and use your discretion.
In telecom, we are moving, say, from a period of price war. In the last 5 years, no telco made money because they were all competing on price after the entry of Jio. But now I would say the industry is down to two and a half players. It is Jio, Airtel, and Vodafone half. And maybe Adani also wants to make an entry now if you have heard the news. But still, my view is these companies will make disproportionate money. So look at telecom and even look at, understand, say, for example, these are very interesting things. Take 5G as a segment. Understand how will that work. What will be needed? What will be needed is you'll need tower. The telco companies will only buy the spectrum and they have all the ecosystem, users and everything. But to connect the two, they will need optic fiber, which will support the low latency, high speed communication. So you need optic fiber cables. Understand who does it. You need more tower info. Understand who does it. In terms of, I would say hospitality, there are segments like hotels and there is travel. So understand there are listed companies, there are listed hotels. Don't think that you'll only invest with the name that you've heard. It may be already priced in on a very high valuation. एक मेरा quick fix बता रहा हूँ on India. In India, the model that works best, the company that makes the most money, is not the company which has the highest quality of product. It is the company whose products are good enough at a good price point for a large mass. Because consumption base is very cost conscious. So think of those kind of companies who can cater to a larger mass and they have huge runway because everything that you and I have been consuming, that cycle will play out in tier 3 and tier 4 cities. Keep that in mind. One sector you can be bullish on is look at how your consumption habits are changing. Like the biggest wealth creators today, I think it was so easy. Boss, you are consuming all products of HUL, if you're using Lux, if you're using Rin, Surf Excel, it is a no-brainer that you can invest in HUL. Look at, I would say, your 20-year-old cousin, ask him where he's spending his money on or where he's spending his time on. Understand, is there a listed company playing on it? Play that cycle, you will be smarter the same way as somebody would have been investing in the most obvious brands now, which were built over 20 years. Look at how a 20-year-old is consuming. So yeah, so those are 3 4 space.
No, that's amazing insights. Thanks for sharing that. Obviously, I mean, we have to reiterate here that none of this is financial advice. I mean, speak to qualified financial advisors for your investing and also apply your discretion, please. Yeah, I mean, I'm reminded of that quote by Rakesh Junjunwala, right? I mean, oftentimes when he is asked to pick sectors, he says that India is like a buffet, right? I mean, it's like a platter. You can pick anything, right? India will grow, and so obviously these sectors will grow as well. While this optimism is there, right? I mean, it's also a very interesting time geopolitically, right? I mean, there is so much of uncertainty around. What do you make of some of this larger macro stuff, right? And how that impacts retail investors? I mean, we're seeing that high inflation, oil is spiking, commodity prices are unstable. There's a war happening in Ukraine and Russia, and we're seeing the chaos that's happening in Sri Lanka and so on. So with all of this unstable macro environment, right? As a retail investor, how much should I worry about all of this stuff?
No, I think it will help. These are big enough events not to ignore. So while I can say you can ignore what the FI is buying or how much they are buying and selling, building a perspective on, I would say, global affairs will help every investor. In this sense, say everything that we are seeing right now as a global economy, we're in a stage of flux, and I don't think we're in a state of change. They say change is the only constant, but the kind of speed of change we are seeing right now, I don't think that has happened in decades. People say that there's a quote, right? Day
Mm.
by day, nothing changes, but when you look back, everything looks different. In this case, you can look back just 2 years and you will feel everything is different pre-COVID and post-COVID. So
Yeah.
that is the speed of change. You don't need to wait for decades to feel the change. So when many things are happening, I would say in terms of inflation, first need to understand why the inflation happened. Inflation is a function of either demand being more than supply or there being too much of money floating in the ecosystem. Both of them happened in the last 2 years because post-COVID, everything was frozen for a while and the central bank said that we have to kind of reinvigorate the economy. They put in money in the hands of people that go and buy. To put in money in the hands, it's called quantitative easing. You don't need to worry about the jargons, but it was easy money policy of the central bank, and that led to increased consumption. That combined, what happened is we started having geopolitical issues which curbed the supply. So you had more money in hand, but your demand, that kind of put the demand wheel in motion, but the supply got like kind of sucked out. When the Russia and Ukraine war happened, Russia and Ukraine contribute to 30 to 40% of the world's food consumption. What Russia is a big, I would say, contributor even on the energy to Europe more than India. Then I would say, you know what, Roshan, if you want to understand, the US inflation print came at 9.1%. It's crazy to think of it कि बॉस इंडिया का इन्फ्लेशन 7% है पर यूएस का इन्फ्लेशन 9% है, हमसे बहुत ज्यादा, ये कभी नहीं हो. So ये उसका भी ना, I put this data out on Multipie also just 2 days back. Yesterday I got this data from a report. If you look at the breakup of which elements have been driving this inflation, top three is energy, food inflation, and the third is rentals for your house. Energy dynamics are changing, and it's a very interesting topic. In fact, even I'm learning about it. But the energy is what drove the last cycle of growth, and that energy was being pegged in US dollar, which is a reserve currency. And currently, what is happening is two things. Countries have realized the kind of disproportionate power US has by having US as a reserve currency, and the main currency for all kind of energy exchange is crazy. Even just the biggest news of last week was an RBI circular that the companies can make settlement in INR in making foreign transactions. There's a word, it is optional. There are various caveats. Just there was a news that I think Jindal or some group settled a very big export deal in yuan, in Japanese yuan, that never happened in history. So very very interesting times in macro. But I think what we need to think as individuals is all of this is leading in a direction wherein India will gain. The world is coming to India. I can tell you that for two reasons. One is for building anything B2C. We have the largest consumers. So think of any big tech in the world. They are all laying red carpet and trying to come to India. They will make videos which will make Indians look good. The racism is going away, by the way. Let me put this, because brands know that more than racism, they need India as a consumer market. So we're in a sweet spot. Our soft power has increased a lot. And I'm not the expert on this. You have experts, but even you would feel the soft power we have gained in the last 3-4 years. And that puts us in a good state. For an investor, yes, inflation is something you should understand. You should also understand that which industries will get more impacted by inflation, which will get lesser impact. But also remember that my view is inflation is transitory, it is not structural. There's a debate in economic parlance, is it structural or transitory? I still think the reason is not anything to do with central banks. The reason is more geopolitical, the mismatch of demand and supply, and sooner or later that will settle down, even though the power centers will change. But 1 to 2 years down the line, we will be well off. As an investor, don't rush into invest now. What you got in March 2020, that opportunity you will get once in every decade, once in 10 years. Again, you got an opportunity in March of this year. Even if index went to a certain level, good companies gave you 20-30% correction. One rule I have is the moment index falls 15% plus from the previous highs, start deploying in tranches, maybe in 2 or 3 tranches. If it is 15% down, at that point you will hear the worst kind of comment. It will make you feel कि अभी तो और double गिरे. Ignore it. The first 1/3 tranche. If it goes to 20%, put in the balance 2/3 in a go, or maybe put another 1/3 tranche and keep the balance 1/3 for a blind SIP. After that, you will beat every mutual fund if you are able to do it. So it's more behavioral. Don't need to worry too much about this. Inflation hai, but I think there's a lot of money at stake, dude. There are people worrying about this more than you have. So this will fall in place.
That's very reassuring. Hey, this has been a fascinating conversation, and really, I mean, there's just so much more that we can deep dive on. But for this podcast, right? Before we end it, what are some people? What are some resources, some books and podcasts, maybe that you would recommend to our listeners? Because you did mention earlier that it's important to follow the right people, right, and the right sources as well. Obviously, Multipie Social, That's at Multipie Social on all platforms, and at Abby Murarka. That's ABHY Murarka on Twitter at least, and I suppose you're on other platforms also. So definitely follow.
No, I'm mostly on Twitter, Roshan. I've realized that that is where I am more like comfortable. So not so much on YouTube or Instagram.
Yeah, so definitely follow Abhishek and Multipie. But any other recommendations before you leave, Abhishek?
Sure, Roshan. So, you know what? I have seen that it might seem daunting because there is so much of information and so much of content, but I've also seen a lot of it as repetitive. What somebody needs is a combination of three things: read two or three good books, at least read one or two good books on the basics of investing. One can be, say, One Up on Wall Street. I highly recommend. Classic. You can read a book called The Warren Buffett Way. If you are into trading, then you can read a book called Reminiscence of a Stock Operator. These couple of books I would recommend very highly. There are many good books. Even in Indian context, we have some recently, some very good books which have come out. There is a book called The Thoughtful Investor by Bharat Shah. So if somebody is looking for content in Indian literature, I recommend that because that came 10 years back, but it is still relevant. It gives you a kind of mental picture of Indian economy. It is very different from the US markets. So The Thoughtful Investor by Bharat Shah is something I can recommend. And recently, the Master Class with Super Investors is another book written in Indian context. If you can read these two books, Thoughtful Investor and Master Class with Super Investors, you will understand how the best fund managers in India look at it. So those are your investing books. The other segment of book which is more behavioral, I think I keep on iterating that behavior control is very important.
Yeah.
So the most basic book is you can read Influence. It will help you in investing also. It will help you in other ways. Robert Cialdini. The other book, if you can really read, the Bible for behavior control is a book called Thinking Fast and Slow. So it's written by two Nobel laureates, Nobel Prize winners in economics and behavior. So Daniel Kahneman. So read that if you can. And the third category of book, which I would say, it's called Annual Report. So it's a book only because those are 200 pages. Keep on reading more of. Try to read 5-6 annual reports in every season. So that will like make you a better investor.
Awesome. Hey, this has been a treasure trove of insights. Certainly, I will be going back to these episodes, listening to it many times over and reflecting on some of the things you said. Again, thank you so much for being on Bharatvaarta. I really, really appreciate this. And for everyone listening, don't forget to follow Abhishek and Multipie Social on social media. We'll be back with a new episode.
Thank you, Roshan. My pleasure. I'll add a book recommendation at the end. There is a book called Why Smart People Make Stupid Money Mistakes. Read it. It's written in a very lucid way. And think, did you make those mistakes? Because it has case studies. And you'll relate, oh, why I made this mistake. So it'll make you a better investor, like even in future. And Roshan, it's been my pleasure. I've been a big fan of your work. And yeah, I would look forward to like more interactions.
Absolutely. Thank you so much, Abhishek.
Thank you, Roshan.
Please note, this is not financial advice. Do consult a qualified financial advisor and use your discretion. Thank you for tuning in to this episode of the Bharatvaarta podcast. If you want to see more content like this, then don't forget to subscribe to our channel. We started Bharatvaarta to facilitate long-form discussions on politics, policy, and culture. We don't necessarily endorse anything that was said in this episode. If you wish to offer us feedback, do reach out to us on social media. We are at Bharatvaarta on Facebook, Twitter, and Instagram. You could also get in touch with us on our website www.bharatvaarta.in. The links are in the description below. Until next time, stay safe, take care, and Jai Hind.